Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Let's talk about something that doesn't usually top anyone's list of favorite topics: tax season. For many retirees, filing taxes can feel stressful, but this year some retirees may see a little relief thanks to a new senior tax deduction introduced in recent federal legislation, sometimes referred to as the Big Beautiful Bill. Whenever something new shows up in the tax code, it tends to generate a lot of attention, and understandably so. If you're retired or approaching retirement, you want to know whether a change like this could potentially reduce what you owe or help you keep more of what you've worked hard to save. But as always, the key is understanding the details. Much of today's discussion is based on a recent USA Today article that's headlined, 4 Things Retirees Need to Know About the New Senior Tax Deduction. I want to walk through those key points and then broaden the conversation to discuss additional money moves for consideration for those nearing retirement. Let's begin with what we think is the most important question: who qualifies? Under the current rules, you may be able to claim this new senior deduction if you were age 65 or older at the end of 2025. That age threshold is step 1. Additionally, you must provide your Social Security number on your tax return, and you must fall within certain income limits based on what's called your Modified Adjusted Gross Income, or MAGI. For single filers, the income limit is $75,000 or less. For married couples filing jointly, it's $150,000 or less. If your MAGI falls within those limits, you may qualify for the full deduction. If your income is above those thresholds, you may still qualify for a reduced deduction, or you may not qualify for this new deduction at all. However, even if you exceed the new income limits, you can still claim the senior tax deduction that existed prior to this legislation. So, this is not an all or nothing situation. Now let me pause here for a moment and emphasize something important. MAGI is not always the same as what people casually think of as income. It's a specific calculation used for tax purposes. In retirement especially, income can come from multiple sources like Social Security, pensions, IRA withdrawals, dividends, capital gains, and how those pieces are structured can influence your eligibility. That's why thoughtful tax planning matters. We don't just look at one number. We look at how the full income picture fits together. Now let's talk about how much this deduction is actually worth. The new senior deduction is worth up to $6,000 for an individual, or up to $12,000 for married couples filing jointly. It's important to note that married couples must file jointly to claim the $12,000 amount. But here's where people sometimes get confused. This is a tax deduction, not a tax credit. A deduction reduces your taxable income. It does not reduce your tax bill dollar for dollar. For example, if you're a single filer with taxable income of $60,000 before the deduction and you qualify for the full $6,000 amount, your taxable income would drop to $54,000. The actual tax savings depends on your tax bracket and overall situation. For some retirees, that may lead to a larger refund. For others, it may simply reduce the amount owed. The key takeaway is this: don't assume the outcome without running the numbers. For some, this deduction may provide meaningful relief. For others, the impact may be modest, but either way, it's worth understanding and incorporating into your broader tax strategy. Now here's another important detail. This deduction is temporary. The legislation created this new senior deduction for tax years 2025 through 2028. As of now, it is not permanent. Future legislation could extend it, modify it, or allow it to expire. That uncertainty is exactly why flexibility matters in retirement planning. If a deduction like this is available, we account for it, but we also stress test the plan under the assumption that it may not always be there. Retirement strategies should be adaptable and not dependent on one temporary provision. If you have any questions about today's topic or how it relates to your current financial strategy, we can help. Visit my website at mnawealth.com or call my office at 866-973-3627 to schedule a complimentary consultation. We're always happy to take a closer look at your numbers and help you understand your options. Now, I'd like to shift gears. So far, we've focused primarily on tax issues affecting people who are already retired. But what about those who are nearing retirement? Maybe within 5 years, maybe within 10. There's a helpful article from Fidelity with the headline, In or Near Retirement: 7 High-Impact Money Moves for 2026. It outlines several strategic actions worth considering as you approach retirement. The first move is revisiting whether you should itemize deductions. In recent years, many taxpayers have defaulted to taking the standard deduction, but depending on your situation, particularly if you have mortgage interest, charitable contributions, or significant state and local taxes, itemizing may still make sense. Tax laws change, personal situations change. What worked for you in the past may not be optimal today. We think it's worth revisiting the conversation. Next is coordinating deductions with your broader strategy. If you qualify for the senior deduction or other tax benefits, the question becomes, how do these pieces fit together? Retirement planning isn't about isolated decisions. It's about alignment and how income timing, deductions, and withdrawal strategies interact. Another key move discussed is considering a Roth conversion. A Roth conversion involves moving funds from a traditional tax-deferred account into a Roth account. You pay taxes on the amount converted now, but future qualified withdrawals may be tax-free. For someone nearing retirement, there may be window years when income temporarily dips, perhaps after leaving full-time work, but before starting Social Security. In those years, a Roth conversion may be worth evaluating. However, this strategy is not for everyone. Once you convert, you can't undo it. You're accelerating taxes into the present in exchange for potential future flexibility. We think careful modeling is essential. The article also emphasizes building a reliable retirement income plan. Accumulating assets is one challenge. Turning those assets into sustainable income is another. As you approach retirement, it becomes critical to ask, how much income will I need? Where will it come from? How will it respond to market fluctuations? This involves Social Security timing, required minimum distributions, and income sequencing. There's a big shift from saving mode to distribution mode, and that shift changes the math. When you're withdrawing assets, the order and timing of returns can matter significantly. Healthcare planning is another major consideration. Medicare enrollment timelines are important, but so is understanding how healthcare costs fit into your long-term projections. Long-term care, especially, can be one of the largest financial variables in retirement. You don't necessarily need a specific product, but you do need a strategy. The article next discusses stress testing your retirement plan. What happens if markets underperform? What happens if tax laws change? What happens if you retire earlier than expected? A plan that only works under ideal conditions isn't really a plan. Stress testing builds confidence that your strategy can withstand variability, which is inevitable. And finally, the article emphasizes working with a financial services professional. Not because you're incapable of managing your finances, but because retirement planning involves multiple layers like taxes, income, healthcare, estate considerations, and risk management. Coordinated guidance can help provide clarity, and clarity can help reduce anxiety. If you look at today's show as a whole, there's a clear theme: preparation. In the first half, we discussed the new senior deduction and the importance of understanding eligibility, value, and temporary nature. In the second half, we broadened the lens to talk about proactive money move considerations for those approaching retirement. Retirement isn't a single decision, it's a sequence of decisions. The more intentional you are in the years leading up to it, the more flexibility you may have once you get there. If you're already retired, it may be time to revisit your tax strategy. If you're approaching retirement, it may be time to examine whether your runway is long enough and stable enough. Either way, the goal isn't perfection. If you have any questions about retirement and your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.